Good morning and welcome to our release of second quarter 2024 performance results for FDIC insured institutions. The banking industry continued to show resilience in the second quarter of this year. Net income increased and asset quality metrics remained generally favorable. However, the industry continued to report weakness in several loan portfolios, which we're monitoring closely, and the net charge-off rate on loans increased during the second quarter. The banking industry's net income of $71.5 billion in the second quarter represented an increase of $7.3 billion, or 11.4% from the prior quarter. This was mainly due to one-time items, including the absence of an FDIC special assessment expense, one-time gains on equity security transactions, and the sale of an institution's insurance division. These benefits to the industry's net income were partially offset by realized losses on the sale of bond securities and higher provision expenses. Community banks reported net income of $6.4 billion. That's a quarterly increase of 1.1%, driven by higher net interest income and non-interest income that more than offset higher non-interest and provision expenses. The net interest margin increased for all size groups of institutions except for the largest banks, as the change in the yield on loans exceeded the change in the cost of deposits. The net interest margin for community banks increased 7 basis points quarter over quarter, reversing a 4-quarter declining trend. However, as a result of the 4 basis point decline in the margin for the largest banks, those with assets over $250 billion, the industry's net interest margin in the aggregate declined 1 basis point to 3.16% and remained below the pre-pandemic average of 3.2% after falling below that level last quarter. Unrealized losses on available for sale and held to maturity securities declined $4 billion to $513 billion in the second quarter. Interest rates rose modestly during the quarter, but the resulting increase in unrealized losses on fixed-rate bonds was more than offset by the sale of bonds by some large banks that resulted in realized losses. This is the 10th straight quarter that the industry has reported unusually high unrealized losses since the Federal Reserve began to raise interest rates in the first quarter of 2022. The industry's total loans increased by $126 billion, or 1%, in the second quarter. Most of the increase was reported in loans to non-depository financial institutions, but much of that growth appears to be simply from the reclassification of existing loans from other loan categories. Consumer loans, mostly credit card loans, also drove the quarterly increase, and all other major loan categories except construction and development loans experienced quarterly growth. The industry's annual rate of loan growth increased in the second quarter to 2%. Total loans at community banks increased 1.7% from the prior quarter and 6.3% from the prior year, led by commercial real estate and residential mortgage loans. Asset quality metrics were generally favorable, despite continued weakness in CRE and credit card portfolios, as well as weakness in multifamily loans. The industry's overall non-current loan rate remained unchanged from the prior quarter at 0.91%, and that's a level still well below the pre-pandemic average non-current rate of 1.28%. But the industry's non-current CRE and multifamily non-current ratios increased quarter over quarter, and the credit card non-current rate remained elevated. Non-current loan balances continued to increase, in the industry's non-owner-occupied CRE loan portfolio. Weak demand for office space continues to soften property values, and higher interest rates are affecting the repayment and refinancing ability of office and other types of non-owner-occupied CRE loans. As a result, the industry's non-current rate for these non-owner-occupied CRE loans in the second quarter was at its highest level since the third quarter of 2013. The increase in non-current, non-owner-occupied loans was largely driven by office loans at banks with more than $250 billion in assets. However, these banks tend to have lower concentrations of such loans in relation to their total assets and capital than smaller institutions, mitigating the overall risk to those large institutions. The next tier of banks, those between 10 and 250 billion in assets, have greater concentrations in non-owner-occupied CRE loans and reported some stress in these loans compared to pre-pandemic non-current rates. Driven in part by write-downs on credit cards, the industry's net charge-off rate increased to 0.68%. That's 20 basis points higher than the prior year's rate, and also 20 basis points higher than the pre-pandemic average. The credit card net charge-off rate increased again in the second quarter and was the highest rate reported since the third quarter of 2011. Domestic deposits decreased this quarter by $198 billion, or 1.1%, a rate well below the pre-pandemic average second quarter growth of 0.2%. Both savings and transaction deposits declined from the prior quarter, with growth in some small time deposits partially offsetting the declines. Broker deposits decreased for the second straight quarter, down $10 billion from the prior quarter. Banks with over $250 billion in assets reported much of the decline in domestic deposits, in part from tax payment outflows. These large banks reported lower uninsured deposits in the second quarter, while banks with assets less than $250 billion actually reported higher uninsured deposit levels. The number of banks on the problem bank list, which encompasses banks that have a CAMELS composite rating of 4 or 5, increased from 63 in the first quarter of 2024 to 66 in the second quarter. That number of problem banks represented 1.5% of total banks, which was within the normal range for non-crisis periods of 1 to 2% of all banks. Total assets held by problem banks increased $1 billion to $83 billion during the quarter. The Deposit Insurance Fund balance was $129 billion as of June 30th. That's up $4 billion from the end of the first quarter. Insured deposits decreased by 0.9%, which was slower than the typical rate of growth for a second quarter. And as a result of the increase in the DIF balance and the lower level of insured deposits, the reserve ratio, that's the fund balance relative to insured deposits, increased by 4 basis points to 1.21%. The reserve ratio currently remains on track to reach the 1.35% minimum reserve ratio by the statutory deadline of September 30th, 2028. So, in conclusion, the banking industry continued to show resilience in the second quarter. However, the industry still faces significant downside risks from uncertainty in the economic outlook, market interest rates, and geopolitical events. These issues could cause credit quality, earnings, and liquidity challenges for the industry. In addition, weakness in certain loan portfolios, particularly office properties, credit cards, and multifamily loans continues to warrant monitoring. These issues, together with funding and margin pressures, will remain matters of ongoing supervisory attention by the FDIC. That concludes my remarks this morning, and I'd be happy to try to respond to any questions. Thank you.
Thank you. We'll now take your questions. Our first question is from Katanga Johnson at Bloomberg. Go ahead.
Thanks so much for taking our questions, Chair Gruenberg. Was curious just about overall, the picture of this report seems mixed, but is it actually more positive in the first instance? And then secondly, we were really curious about whether you're no longer as worried about unrealized losses this quarter compared to last quarter. Any views on changes in your worries there?
I think what we're seeing this quarter is a continuation of the trend we've seen in the last few quarters: stability by the industry, continued resilience, but underlying vulnerabilities, which in the current economic environment, warrant careful attention from a supervisory standpoint. And on unrealized losses, the change here is marginal. I think it's still, as we noted, quite high, and has been high for a considerable period of time now, and remains a point of vulnerability, in what remains a high interest rate environment.
Our next question is from Victoria Guida at Politico. Go ahead, Victoria.
Hi, Chairman. Thanks for taking our questions. Just kind of building off of Katanga's question, with the Federal Reserve looking poised to start cutting interest rates, I'm wondering if you could speak to both unrealized losses, but sort of the outlook for the banking sector generally. Do you think that is going to take pressure off of banks? Or, what does that mean for net interest margin? I'm just sort of curious how you're, at a macro level, seeing how these cuts are going to affect both, the risks and benefits to banks.
It's an important question, and obviously built in there is an assumption about what the Fed's going to do. But assuming there is a reduction, the premise of your question is that the Fed's going to reduce rates. I think if that occurs, that'll be a benefit to banks, particularly in regard to on-balance sheet assets, securities that they're holding on their balance sheets, because it's the higher interest rates that have precipitated the unrealized losses. If interest rates come down, that'll reduce the unrealized losses on their balance sheets. That would apply to loans that have accumulated unrealized losses on their balance sheets as well. So I think a particular benefit to the banking industry, if the Fed should lower rates, would be some benefit on their balance sheet exposures to those assets.
David Hollerith at Yahoo Finance. Go ahead, David.
Hey, Chair Gruenberg. Thanks for taking our questions. To build off of what Victoria was asking, sort of in the same scenario, could you sort of talk about what your expectation is for different loan categories and how they might react? I think commercial real estate is an area where a lot of investors have sort of talked about seeing relief for some of those borrowers. And I wanted to know if you had any more of an idea about what could happen in that specific area. Thanks.
It's tricky to speculate about that. A lower interest rate environment should be beneficial to commercial real estate exposures generally, and perhaps in the office space sector, both from the standpoint of the actual loan obligations and if there's a stimulus to the economy as well, that would be helpful. But we're trying to anticipate future events, so we'll really have to see how things play out.
We're going to go back to Katanga Johnson at Bloomberg. Go ahead, Katanga.
We were really curious just about a non-QBP matter that our audience is really eager to learn more about, and that has to do with the capital plan, the Basel III Endgame. We've reported a lot about discussions privately among the regulators, but I thought maybe this might be an opportunity to maybe get an update on anything related to the substance of changes or perhaps timing. Just wanted to open the floor for any updates you'd like to provide on that.
No, I appreciate the question, but Katanga, I don't think I'm going to make any news this morning on Basel III. Only to say that, the agencies are very focused on it and are working hard on it. And I think there will be an outcome, but I don't think I can say anything more than that at this point.
I understand. Is the effort to potentially, with all that's happening, is eyeing toward the end of the year something that's front of mind for you?
Meant on timing at this point, but we're working on it, and it's very much a focus of attention.
Thank you.
Victoria, go ahead.
Hey, so just a quick clarification. When you say we're working on it, are you talking about a reproposal, a final rule, a series of questions along with the QIS results? Just sort of point of clarification there.
Just to be clear, although less clear than you would like, we are working on the Basel III capital rule, and more than that, I'm not going to say at this point. But I do think it's something we hope very focused on acting on.
Can I also just ask, Comptroller Sue gave a speech this week in which she talked about how supervisors should consider having a process for formally designating domestic systemically important banks. Is that something that you're interested in pursuing as well?
Look, I think that's a very important subject, and it really goes to the issue of the institutions below the level of our so-called global systemically important banks, large regional banks, which, as we saw last year, when they get into trouble, really can have systemic consequence. And whether you want to formally label them domestic systemically important banks or not, they really need to be a focus of attention and priority in thinking about a large bank resolution. And as you know, the FDIC finalized a rule to significantly strengthen the resolution plan requirements that we have for those institutions. Because for those regional banks, the bank itself is 95% or more of the assets of those companies. So it's really about the bank and the resolution of the bank. So strengthening the bank level resolution plan. And of course, we also have pending a notice of proposed rulemaking that I think we hope to finalize in the near future, which would require a holding of long-term debt by banks over $100 billion. I think those two things, stronger resolution planning to give both the banks and the agencies a better understanding and preparation in the event of failure, and a long-term debt buffer, which would provide loss-absorbing resources in resolution that I think would greatly facilitate the orderly failure of institutions in that category and avoid a systemic consequence, are really important steps to take. And they go to the underlying point that the controller made, which is that these institutions, even if they don't have the cross-border operations of the so-called GSIBs, are of sufficient size and consequence that they really can be of systemic significance if they get into difficulty.
Evan Weinberger at Bloomberg Law. Go ahead.
Hi, thanks so much for the time today, Chairman Gruenberg. So we reported today that the FDIC is preparing new regulations related to FBO accounts held by banks, dealing with some of the problems that arose with the Synapse bankruptcy. I was just wondering if you could talk a little bit more about what the FDIC is preparing to do, or what this might look like to prevent customers getting locked out of their accounts in future instances like this.
Appreciate the question. I'm not in a position to, to be specific about it, but the Synapse failure really illustrated the risks to banks and depositors when banks rely on third parties to be the conduit for deposits, and the need for adequate record keeping so that the bank knows who the ultimate depositors are and who's actually covered by deposit insurance is really a very important issue. And I think, as I've indicated in the past, this is a matter of attention for the FDIC, and we may consider regulatory proposals in this regard.
Thank you very much.
Sure.
Steve Gandel at the Financial Times. Go ahead, Steve.
Hi. A number of banks were cited for deficiencies in their living wills, and I believe they have until the end of this month, to give you an update on, or give you a plan. Could you tell us a little bit about where that process is? Are you engaged with the banks on? Do you think that the banks are going to meet that deadline of coming back to you? I think it's mostly on derivatives.
Yes, Steve, just to be sure I heard you, this is in regard to the resolution plans?
Yes, the resolution plans that the few people are deficient, and they have to give you a plan by the end of this month, how they.
Yeah, we expect all of those institutions to be responsive, if that's the question.
Okay. So can I ask another question about, well, I'm going to do it, Abby. The problem bank list. There's been some criticism over the fact that the camels might be outdated to pick up any of the banks that failed last year. Are you all looking at, and then also, like you talked about how CRE is problematic, and yet the problem bank list didn't move this quarter. Are you all talking about revising how you put together the problem bank list, or do you think those criticisms are fair?
It's a good question. I think there were supervisory issues relating to those bank failures last year. I don't know that I would, cite the Camel's rating system as itself particularly implicated by it. I think the reports that were done on the failed banks last year generally found that the examiners were aware of the issues and brought them to the attention of the management and boards of those institutions, and were reflected in Camel's ratings. So there could have been more, I agree with you, more aggressive treatment there. I think the core issue was whether the agencies acted forcefully enough on the issues that they had identified at those institutions. So there's always room to look at the Camel's ratings and see if they're doing the job they should in terms of evaluating the condition of the institutions. But in terms of the bank failures last year, I'm not sure that's a core issue. I do think there are important supervisory lessons for the agencies to learn, and I think we have been trying to apply those lessons both in our examination work and in rulemakings that we've undertaken.
Do I get one more? Can you give us any more progress update on efforts to reform culture at the FDIC?
As you know, we've had an action plan in place since last December. We've now incorporated all the recommendations from a third-party review that was overseen by a special committee of our board. And we've just recently announced, pursuant to recommendations we received from that third-party review, the appointment of an independent transformation monitor to audit the agency's implementation of all the recommendations from our own action plan, the third-party review, as well as recommendations from our Inspector General. And we also just announced, again, pursuant to recommendations made, the appointment of a third-party expert to advise the agency on our efforts to address workplace culture. And as you know or may know, the FDIC board has also approved the establishment of 2 new independent offices that will take responsibility for receiving all complaints of harassment and discrimination, arrange for independent third-party investigations of those complaints, and be responsible for any discipline as a result of those investigations. Those 2 new offices will be outside of the management structure of the agency, reporting directly to the board, and we're now well into the process of selecting directors for those 2 offices. So this has been the top priority for the agency. We've been working very hard on it. We believe we're making meaningful progress, and it's going to be a focus of all of our attention.
Go ahead and, one more question. Victoria, you get the last one, and then we'll conclude our live stream. Go ahead, Victoria.
Yeah, just to follow up on that, I was just wondering, Chair Gruenberg, if you wanted to respond more directly to some of the criticisms from Jonathan McKernan that basically the process that you all have laid out would make it more difficult for outside investigators to get the information that they need to properly investigate the officials at the agency.
I think the board approved a resolution. Well, first of all, as I mentioned in the previous question, the board has approved the establishment of 2 new independent offices that will take responsibility for receiving all complaints of harassment and discrimination and arranging for third-party investigations of those complaints. The board recently approved as an interim measure the utilization of other federal agencies to arrange for third-party investigations of any complaints for employees until these new offices are up and running. We thought that was really an important thing to do, to get independent investigations of any complaints from employees going as soon as possible. We thought that was a meaningful response to the issue, and I'll leave to you to raise any further questions with other members of the board.
Okay, we will conclude our live stream. And if you'd like to stay on the line, we'll have some senior staff available to take any additional questions that you may have about the quarterly results. Thank you so much for joining us today.
Great.
Talk soon.
Thank you all very much. Appreciate it. Take care.
All right, we have Pat on and Doreen, I see. Just pull up Pat for us and then we will. Okay, go ahead, Katanga.
Hi there. I